of myself, the host of ICW, Eddy Cocciollo. Of course, that's why you tune in. We know that's not true. It's funny, a quick story. We had the first night, which was beautiful, by the way. How about that first night? That welcome night was unreal. Unreal. And I'm just talking with Sherry. We're just chatting, and like I was maybe 2 feet from her, and then someone came in, and I was 4 or 5. She had a huge crowd around. Everybody's a huge fan of yours, Sherry. I'm just there for eye candy. Let's face it. That's my role on ICW. But we are so proud to have our chief economist here at DLC. This has been an incredible run of ICW. We literally have thousands of fans, thousands and thousands of fans. We're going to hit that 10,000 fan mark soon enough. Maybe it's here in Mexico. Why wouldn't it be? Please put your hands together for your chief economist, Dr. Sherry Cooper. Okay, you're ready. Get ready with the pictures.
Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time homebuyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
Thank you so much. Wow, this is awesome. This is why I do what I do. So I just want to, of course that's happening, right? I just want to start off by talking a little bit about the question on this page, which is, when will interest rates fall? I'm sure you get those questions all the time. But what I want to comment about is no one knows, okay? No one knows. Tiff Macklem doesn't know. Jerome Powell doesn't know. Chrystia Freeland doesn't know. This is a VUCA world. VUCA, I've talked about it before, but I just want to remind you, it's an acronym that stands for volatility, uncertainty, complexity, and ambiguity. This is what we're living with. It's the things that we don't expect that actually make the biggest impact on the economy. If everyone expected COVID, we wouldn't have had interest rates falling to 25 basis points. And we continue day to day with the most extraordinary volatility, certainly in my career. So what do you really feel about this? It's unnerving. Everyone is still in shock just from the whole pandemic, let alone everything that's happened since. But if we didn't have VUCA, we wouldn't need all of you or me or the other people that are providing advice, providing a calming hand, telling clients that you can't time markets. I've never met anyone who's met anyone who can consistently time markets. So we all live our lives with this tremendous uncertainty. And we're fortunate because the fact is Canada is rock solid. And we are living in a period where so many other countries in the world are experiencing tremendous divisiveness. Look what's happening in the United States. Look what's happening in France. Look at the UK, countries all over the world. Canada's economy will continue to be resilient. As well, the economy, though, will continue to bounce around. We just saw a fourth quarter GDP number that was zero growth. Well, guess what? The first quarter, we're likely to see 1.5% growth. No one expected that. You know, I follow all the economists on Bay Street. No one had predicted that. So, right now, we just got the January GDP figure. Much stronger than expected. It's nerves. I've done this thousands of times. It's still nerves. Thank you. That's my comfort right there. As long as that's there, it's like my little comfort blanket. I know I can proceed. The January GDP number was much stronger than expected. This just shows you all the sectors that had significant growth. As a result of this, of course, we're not going to see 0% growth in the first quarter. In fact, looking at this chart, you see that recession keeps getting moved forward because the Canadian consumer is confident, because businesses are investing, because for all the layoff announcements that we keep hearing, predominantly in the United States, but elsewhere as well, for all of that, the job market is still extremely tight. We've had interest rates increase proportionately more than ever before in 1 year in the history of our data. And yet, the economy is still growing. Yes, we've had a correction in the housing market, but it's just a correction. In fact, home prices on average are still up almost 30% from prior to the pandemic. Yes, interest rates have increased, and in some cases, interest rates have increased very sharply. But indeed, the economy is still growing. We see here that consumer discretionary spending is still strong. Look at the yellow line, that's discretionary service spending. So, you know, we're still getting manicures. We're still getting our hair done. We are still spending. And people are still wanting to buy a home. Either a bigger home, a smaller home, a first home. People are moving up. People are moving to widely dispersed regions now because we can. The one thing we learned in the pandemic is we can be productive working at home. In fact, that will not turn back the clock. We will not go back to the before times. Do you know that people are quitting jobs, good jobs, if their boss says you have to be sitting in this office every day of the work week? People are moving to other level of unemployment. For Canada, that would be about 6.5%. So there is tremendous demand for talent. In addition, there are job vacancies that are going unfilled. Lots of the banks on Bay Street, in fact, have put forth an edict that you must be working 5 days a week in your office, and you better believe that they're having trouble keeping their top talent. These kinds of changes are unpredictable. Who knew? And as a result, we've got empty office towers all over the country. Office towers that in some countries already, New York City, for example, they have turned office buildings into condos. Because we have a housing shortage, it makes perfect sense. Did you hear anything about that in the budget? Of course not. So it's so much opportunity out there. Too many people are just focusing on the problems. And goodness knows we have plenty of those. But there is time and energy for innovation. Where you can see that labor demand has slowed, but it is still very, very strong. Vacancy rates have edged down. The share of total jobs that have gone unfilled have edged down, but it's still near record high levels. And in addition to that, we see wage rates are rising rapidly. The latest data we have for February shows 5.4% increase year over year in wages. People have actually become more productive, mainly because the time it takes to get to the office, plus all the energy it takes to be in your office wear day after day after day, turned out to be very unproductive. You can get a whole lot done at home. And in fact, many people work much longer hours because they could. And they wanted to. They had the flexibility. They were engaged in what they do. Now, inflation. I've had debates with many of you over the last 8 years about fixed versus variable mortgages. I've had debates with all of you saying that interest rates don't just fall. Now, I obviously have watched interest rates fall. I remember an audience in the early 80s where I said to them that a 10% 10-year yield is one day going to seem like a very high rate. People didn't believe me. And the fact is that, 10% 10-year yields, we haven't seen anything close to that. Interest rates have been on a secular decline for 40 years. So no wonder most of you thought inflation was yesterday's problem. But it isn't. When you have excess demand, for whatever reason, prices tend to rise. And that's exactly what the Bank of Canada is dealing with. They made a mistake. The mistake was they took the overnight rate down to a mere 25 basis points. And then they left it there for about a year too long. As a result, we are bailing our way gradually out of it. Many countries in the world would love this profile of CPI inflation. Our inflation rate has now moved down to 5.2%. That's still not anywhere near the 2% target. Also, one of the reasons that we've seen the big dip in the February data is because of the base effect. 1 year ago, February, inflation was already running at about 8%. We've dropped that out. And then, of course, it looks like year-over-year inflation has been more modest because a year ago, prices were already very high. But the embeddedness of inflation is with us. We see that in the demands for higher wages. That becomes self-fulfilling as we get wage price spiraling. And the Bank of Canada has just paused because they know that there are long and variable lags between raising interest rates and the full effect of that on the economy to slow things enough that we see the inflation numbers come back to target. Now, what we're seeing here is that core inflation has also come down. This is the Bank of Canada's three favorite measures of core inflation. That too is coming down. There's a lot more confidence now that we've broken the back of the worst of the inflation. The goods inflation now is slightly below service inflation. And that makes sense, but just 2 days ago, big announcement overnight that OPEC is cutting production by an enormous amount. And suddenly there's the prediction that oil is going back to above $100 a barrel. That's a big fundamental. Now, it's great for Alberta, don't get me wrong. Canada is positively impacted by that. But of course, it means that gasoline prices will rise again. It means that all the spin-off effects of higher energy prices could well be back in train. And there's nothing any central bank in the world can do about it. So the Bank of Canada's pause certainly makes sense. We've done a great job in wrapping our arms around the excess demand in the economy and bringing it down. We've also done a great job in beginning to unlock all the supply chain bottlenecks. All of that is good news. I do believe that when the bank meets again, April 12th, so very soon, they will also pause. And indeed, they're going to keep interest rates at roughly these levels until 2024. I do not believe that the Bank of Canada will cut interest rates this year, even if we do move into recession, because they don't want to risk having to raise rates even more in the future. Why should they want to do that? They would lose credibility. So we are going to see that the 4.5% overnight yield may well be the peak in interest rates, but the inflation is really the key. So until we see 2% inflation on a sustained basis, we can't expect much in the way of government-generated interest rate cuts. But that doesn't mean that interest rates haven't fallen. In fact, market-driven interest rates have been more volatile in the last 6 weeks than in any other similar period. Great gyrations in the 2-year bond yield, in the 5-year bond yield, in the 10-year bond yield every day. Just as recently as 1 month ago, on March 8th, the Fed chair, in his testimony to Congress, he said that interest rates will rise faster to higher levels and remain there longer than expected. The markets went nuts. Interest rates popped up across the yield curve. Remember, the yield curve is inverted, which in itself predicts recession. And here, the central bank chair is telling us that interest rates are likely to go to, people were betting roughly 6%. Now, the Fed notoriously has, every time there's been a major tightening, we've seen some sort of crisis. They break something. Those businesses that in fact were not well managed, those businesses, as Warren Buffett says, were swimming naked. When the tide goes out, you see who's been swimming naked. Well, that just happened. In fact, just a week after the comments by VUCA, we heard the announcement that Silicon Valley Bank was in trouble. And then two more banks in the United States, and then Credit Suisse, also a very troubled bank. Now, the spillover effects of this are what they're trying to control. A run on a bank is never a good thing. And when there is a run on a bank, because of our fractional reserve system, no bank, not the most solid bank in the world, can actually continue to function. The central banks have now announced, the Fed most importantly, that the discount window is wide open. They will finance whatever it takes to keep people's confidence high. And immediately, there was a rush to take this money. Banks, in fact, have now used that financing vehicle to the tune of billions of dollars, just to keep a safety net, just in case. Now, it appears things are beginning to settle down, but what the Fed did is they actually said they would raise interest rates only 25 basis points at their last meeting. Now, the market prior to the failure of SVB did expect a 50 basis point rate hike. The Fed can do two things at once. The Fed regulates the federally insured banks as well as conducting monetary policy. The Fed is not finished raising interest rates. And in fact, you can see here, this shows you the real overnight rate. So it's the level of the overnight rate minus inflation. And you see it is still negative. Negative in Canada too. We've got 4.5% overnight rate and 5.2% inflation. Historically, it took very high interest rates, positive real interest rates, to break the back of inflation. We've also seen that Canadian debt levels are at a record high, and therefore we are more interest sensitive than many other countries. And then compound that with the fact that our mortgages really only have roughly 5-year terms, even if you got a fixed mortgage. And so Canadians are very sensitive to what the Bank of Canada does. This shows you other countries that are as vulnerable to the movement in interest rates. And this is measured by just the proportion of mortgages outstanding that are variable rate. You see it's highest in Australia. And then as we move down the list, Canada is number 4. In the US, of course, people get 30-year fixed rate loans, by far the predominantly most popular. And therefore, they don't have to worry about whether rates go up or down, and therefore it's much tougher for the Fed to slow the economy. Whereas in Canada, because it impacts psychology so tremendously that people begin to tighten their belts when they're expecting that they're going to see higher monthly payments. Now, this just shows you the volatility. On March 24, the 5-year yield was at 2.6%. The high for the 52-week range, of course, was just shy of 4%. 1 week later, it's above 3 again. As of yesterday, it was below 3. These are market gyrations. We also see the steeply inverted yield curve. This blue line is 1 year ago yield curve and today's yield curve. Short-term interest rates are significantly above long-term rates, which means that the markets are predicting that the economy is going to go into recession. It's not always right, but clearly there is that fear. And the fact of it is that the Fed and the Bank of Canada would like a soft landing. And by soft landing, they're saying they want to see a couple of quarters of small negative growth. It's more of a stall than a deep recession. And in addition, we've got a housing market that has reacted substantially to the rapid increase in interest rates, just as it reacted to the rapid decrease in interest rates. So the data are showing that the housing market in Canada has slowed considerably. Housing activity has slowed. Even housing starts have slowed because higher interest rates affect not just demand, but supply as well. Many, many developers have stalled projects in train because their loans are, in fact, more expensive. And so we've already got a major housing shortage, and that shortage is aggravated by these fundamental factors. Now, this shows you sales, and you see there was a slight uptick in February. We're going to get the March data in the middle of the month. The preliminary data are showing a pickup, as you'd expect. Calgary yesterday announced their results for April, and for March, and they said that prices are rising. Of course, it is oil country, and that demand is picking up. The other thing we've seen is that new listings have plummeted. There isn't a lot of forced selling here. People are making it through. We have a huge proportion of variable rate loans that have hit their trigger point. And what we're seeing is that we've gone from a major seller's market where, multiple bidding situations were just everywhere to one that's much more balanced. But there still isn't enough supply. There's not a whole lot to buy because, again, the sellers are on the sidelines thinking that home prices are going to return to the recent levels of a year ago. Now, we've seen that the home price index year over year has fallen significantly, but it is not a crash, far from it. And it is very likely that we're going to see in 1 year's time a reversal of most of the decline. This just shows you the peak price, average benchmark price of each of those regions, and then the most recent price. And you see that for the GTA, we're down 22%. For Canada as a whole, down almost 20%. And the list goes on, where Alberta, you see, is still in positive territory. Now, Because rising interest rates slows not just the demand for housing, but the supply of housing, this has really exacerbated the housing shortage. And if you remember last year's budget, that was all about housing. The thing is that the federal government doesn't have control of zoning. It doesn't have a say in whether you can put a densely populated building development in single-family home areas. Of course, homeowners in those single-family houses don't want it. And because the zoning is determined by local governments and people vote for those local politicians, nobody wants to have the density in their backyard. And that's been an intractable problem in Canada for a very, very long time. Now, fixed rate loans have become more popular in the last year for obvious reasons. The variable rate borrowing represents now 24.3% of new funds advanced versus the fixed rate, and that's down from 53.5% variable at the end of 2021. In addition, as I've said, many of these variable rate borrowers had hit their trigger points, and most of them are fixed payment loans. So in most cases, people haven't felt the full effect of the interest rate increases yet. The thing is, though, that most of the banks are now reporting that their loan books, the remaining maturity of their loan books is over 30 years, is about 30%. And that's the case for all of the banks. And what they have said is that the contract reverts to the original amortization schedule when they begin to roll over. Now, in the budget, buried deep in an appendix, there was a statement that Chrystia Freeland said that the bank should do whatever it takes to keep families in their homes and make it easier for them to deal with their monthly payments. And they said that amortizations could be much, much higher than 25 years. Now, I want to know what OSFI thinks of that. You know, the Department of Finance can say whatever they want, but Peter Rutledge is basically in charge of whether or not the banks will be allowed to do that. Now, we just saw him talking about how much risk there is in the marketplace. This chart shows you the share of high loan to income, and then they define that as greater than 450%. At originations industry-wide. Pre-pandemic, the average was under 24%, but post-pandemic, it is much, much higher. And so that's why they put forward proposals, and it was like a laundry list of potential proposals to reduce this so that people, in fact, would not run up against the problem of rising monthly payments every time the 5 years or 3 years or whatever the period is occurs. And they put it out for comment. The comment period ends April 14th, very soon. And then we're going to hear what the next shoe to drop will be from OSFI. Now, the Department of Finance would love to see 40-year amortizations, because that means that monthly payments for most people would be more manageable. Of course, it also means that their mortgage is going to last a whole lot longer. But nevertheless, you know, I kind of believe that OSFI isn't going to go for that. So a rebound in housing activity is going to happen. It will be gradual this year. In 2024, we're going to see it accelerate. And the reason I'm confident of that is simply because Canada's population is growing very rapidly. And it is by choice that Canada has decided that they would open the floodgates to immigration. And this just shows you the plan. They've exceeded their plan year after year. And by 2025, 500,000 immigrants will come into Canada. And these people need a place to live. This has been a very important factor in the rise in rents. In addition, you see that international migration to Canada has spiked. Now, no doubt that has something to do with the fact that the US has shut its borders. But it was always easier for immigrants to get into Canada than the United States. This is a record influx, and not only is that relevant, but most of these people that come in typically move to the urban centers. So this just shows you the latest data for Toronto, and you see that huge spike of new Canadians or new potential Canadians coming in. And at the same time, we've seen a huge increase in rents. Now, with rent controls, if the tenant remains in the property, you can't raise the rent more than 2.5%. But the fact is that there's been a lot of turnover, and those people are seeing 20% higher rates, rental rates, than the previous tenant. So the affordability issue is front and center, and it is only going to continue to be an enormous problem, which tells you that home prices inevitably are going to rise again. And there's nothing that the government is doing about that. Yeah, they have an accelerator fund, and yes, they are putting low-cost housing in certain places, but it is nowhere near the degree that would be required in order to reduce the upward pressure on home prices. Thank you. Okay.
All right. So today's ICW was sponsored by Manulife Bank. Thank you, Manulife Bank. And Sherry, there's lots going on, and you said there's no rates going to be going up anytime soon, probably till next year. I just looked, the 5-year bond, for whatever reason, the volatility just continues getting crushed. I just talked to Jason Ellis, and he thinks it's something to do with the banks south of the border again. What are your thoughts on the volatility? Is that going to be dangerous if that continues, or is that just going to be something that we need to get used to?
Well, you know, it's unnerving for sure, but I don't think for Canada it's dangerous. And I say that because our banks are so heavily regulated, have such high tier 1 capital, and because we're nationwide in most cases, for banks, for financial institutions, there's great diversity of the client base, unlike Silicon Valley Bank, where all the major depositors were basically startup tech companies or venture capital companies, and that's a very tight-knit group. So as soon as they started on Twitter to diss the SVB, there was a run within minutes. That doesn't happen in Canada. So I do think that, we'll get through this. Of course, now the stock prices of our banks have fallen sharply, and that is inevitable because financial markets move in great waves, and we're always battered about when the U.S. has a crisis.
Banks are on sales. Why not buy more, right? Yeah. If you have any questions, please put up your hand. We do have mics. There's a few out there. I think, Greg, you got somebody?
Hi, Dr. Cooper. Sorry. Is the 2% benchmark they're looking for appropriate in this environment still?
Yes. And the reason I say that so quickly is the banks have long stated that their target is 2%. In fact, what they say is it's 1 to 3%. Over the last 10 years, by the way, prior to just the past year, inflation in Canada and the United States was below 2%. Repeatedly. And that's why we saw overnight rates as low as 1.75% when the pandemic began. Interest rates will not go back to that level. In fact, it's unlikely that the big decline in interest rates, though we're likely to see a decline in interest rates when inflation is at 2%, it's not going to be levels of negative real interest rates.
Got another question? Yeah. Sean Humphrey. Hey, Sean.
How's it going, Eddy?
Good.
Could you stand up? Because I don't know. I can't.
Yeah, stand up.
Yeah, stand up.
The real Slim Shady. Please stand up.
Okay.
Hey, Sherry. So you spoke about that the Fed is not done increasing interest rates, but Canada seems like we've raised. I keep hearing that about historically Canada has been below the US, but I also hear that when the US raises rates, Canada has to follow. In terms of like the difference between the two, can you just comment on that?
Yeah, there's no hard and fast rules. Back in the real inflation period in the late 70s and early 80s, Canadian rates were above US rates, and by a fair margin. So that's more typical. But our economy has become even more interest sensitive than it was long ago. And so the slowdown in our economy is likely to be more aggressive than in the US, just because we are so vulnerable to the higher interest rates. I think that the US will raise rates to levels significantly higher than in Canada. That's not going to be good for our currency. And that in itself is inflationary because we import so much from the United States as well as the rest of the world. But if inflation starts picking up for that reason, you better believe that the Bank of Canada will increase interest rates. I mean, they've made it clear it's all data dependent. So, and none of us know what that data will show, so it's certainly possible. But what I would tell you, and you should tell your clients, is that you can't time these markets. And if you think that interest rates are going to plunge and prices are going to remain low, no way. Mm-hmm. No way. Prices will move back up. Like, you can't have both. So clearly, it's a lifestyle decision. I certainly believe that investment in real estate has slowed, and for obvious reasons. But again, we do have a housing shortage, and we'll continue to have a housing shortage.
You got a question?
All right, we actually have a question from online, Eddy and Sherry,
All right, let's hear
through
it.
the millions of people watching on the live stream right now. So here we go. It's a fairly long question, Sherry. If the feds are expected to raise rates and the Bank of Canada does not, will this result in a weaker dollar? Would this weaker dollar not result in increased exports of Canadian goods and services, resulting in higher inflation? Thus, higher for longer is here to stay for much longer than 2024. What is Dr. Cooper's thoughts on this?
That's Avery Schenfeld
That's
from
a-
CIBC. Thanks, Avery.
We just talked about exactly that. So yes, a weaker currency is inflationary, and that's the rub that the Bank of Canada has to deal with. So we never get very far away from parity in a sense of interest rates with the US. And I mean, that's just a fact of the existence of the trade relationships between the two countries and our inability to export oil to Asia.
Got a question up here in the front.
Good morning. I have a question about volumes are decreasing with new business at the banks. Do you see them capitulating and dropping their spread over the bank rate versus prime to try and maybe buck the Bank of Canada a little bit, but to maybe soften the landing for all of these variable rate borrowers and also trying to stimulate more volume for their books?
Well, again, that's going to depend a lot on OSFI, because OSFI is very concerned about the risk embedded in their banking system. That's their job. I mean, that's their only job, is that they regulate federal institutions, and they've done everything to prevent too many households getting too big a mortgage, much bigger than they could afford. But did that imply that they could afford it when interest rates rise by 425 basis points? No, people had to qualify at 200 basis points above contract. That was a good move in the sense that things could be even dicier had they not done that. But will they raise those thresholds for qualification? That's one of the problems. That's one of the things that they were talking about, as a potential to do.
Yep. Monique. It is.
Hi,
Hey, Monique.
Eddy. Hello. Oh,
Hello.
hi. Hi, Sherry.
Hi.
So actually, that was a great segue, what you just said. My question is what you anticipate OSFI to do. Obviously, you mentioned you can't foresee them extending amortizations, but do you foresee them just kind of keeping things steady, or do you think maybe they are going to make it a little bit harder?
Well, the federal government has really whacked the banks. Remember, they have a brand new tax that they're paying that was introduced last year. And then in the current budget, now they're going to be taxed on dividends they earn from other, not subsidiaries, but other corporations. And that's that in itself. Now, I'm not suggesting that the banks can't handle that. Of course they can. But in Canada, the banks play a unique role. And the unique role they play is they represent such a large proportion of the stock market that many, many, many people have investment in banks, either directly by buying their stocks or indirectly because their pension funds are heavily invested in the banks. And their dividends are what people live on in retirement, whether directly or indirectly. And so it's not, OSFI's got a tough thing. And the regulator, I mean, the reason we didn't have a financial crisis in Canada in '08 is because the regulator doesn't pander to the CEOs. It's quite the other way around. When OSFI calls, they show up. And so it's not like as much as the Canadian Bankers Association lobbies on behalf of the banks, it doesn't work when it comes to OSFI. So, we're about to see that. That's just another one of the unknowns that's very complex. Most people don't even understand that happens. And it could have quite significant ramifications for the economy as a whole.
We have time for a couple more questions. Jason Nugent, of course. Staple and ICW, ladies and gentlemen.
That stands for in conversation with, for anybody who hasn't clued into that.
Hello.
It's on. If the ON just
It was on. It just didn't light up. Sherry, what do you think the odds are with enough backlash, the feds will blink on immigration?
Tell me, this all began in 2016. It's not like this has been going on forever. And in 2015, Trudeau put Dominic Barnes in the role of the chair of a committee to discuss, how do you make Canada grow rapidly? How do we improve our productivity? How do we have a greater underlying momentum in our economy? And the big thing that the Trudeau government took from that was population growth, because Canadians on their own, that because the boomers are aging and aged, that there's tremendous labor shortages when you just think about all the boomers that are leaving the workforce. We see it in the construction industry as an example. And so they need to bring people in. And they never discussed where are all these people going to live. Seriously, it's crazy. So will they back down? I don't think so. But then, Justin Trudeau isn't always going to be prime minister. A new government might change that. Oh my God.
Yeah, all flights are canceled going home. We're staying in Mexico.
Right.
We have time for one more question. I think there's one over here. Yeah. And I'm sorry, I can't see your face because it's I think it's Eitan. Is it Eitan? All right,
Yes.
Eitan Pinsky.
Hi. Sorry, loud. I know a lot of things. There's some things I don't know. And I think a lot of you guys don't know this, but what impacts the discount off prime on the variable? Why is it 1% sometimes? And why is it prime minus 0.5? I can't explain that to my clients in a way that makes sense to me.
Well, obviously, it's because the banks decide what it will be, and they do that based on, all sorts of criteria, and it's political. The banks never get too far away from each other and all this. It's like, it's a collusion that is allowed, let's say. So will the banks, like their posted rates have come down, but nobody borrows at the posted rate. It's like a nonsense rate. So, behind the scenes, they want to buy market share or they don't want to buy market share. And that's the decisions they're going to make.
Well, Mario at Manulife said his discount would be a little lower because they had to pay for this trip. So thank you for your sponsorship, by the way, Manulife. This is going to conclude our ICW live from Puerto Vallarta, Mexico.
Thank you.
Thank you so much for making it an incredible experience. Thank you, Sherry, for always being what you are, which is amazing. You still have the clicker?
No, I put it down.
Okay. Maybe you press it once to see what happens. This is going to conclude our morning, and we're going to go on a break. It is going to be 15 minutes unless I get yelled at for a different time. We're going to be back here. We have an incredible afternoon for you guys. Please be sure you're on time. We have two.
Sorry, Eddie, just 1 second. We actually want to thank yet again Manulife. And before everyone leaves, we're going to play a short video from Manulife. So here we go with that.
It's like the voice of God there.
Yeah.
This great conference. As your strategic lending partner, Manulife is here to help inspire your clients to be in charge of their own mortgage. So how does that work? It's all about putting your clients' hard-earned money into their own pockets first. Then we let them decide how they want to repay on their mortgage depending on their changing expenses and other cash flow needs. They can pay off their debt as fast or as slow as they like. In uncertain times like we have right now, with rising interest rates, stubborn inflation, and fears of a recession, the ability to make your own borrowing and repayment decisions based on your family's needs is the highest priority. Manulife Bank can help you change the conversation away from interest rates and help your clients focus on payment flexibility. We have a strong team of business development managers and personal mortgage consultants that are here to support brokers who are inspired enough to want to take the time to find out how Manulife One works and why it continues to support Canadians in their financial wellness. Now is the time to get inspired to change. Talk to your BDM when you get home, or why not come over and introduce yourself? I'm down here at the conference with you, and so is our amazing Manulife Bank leadership team. We'd love the opportunity to meet and chat. Thanks for your time and enjoy the rest of the conference.
Yeah. So let's make it an even 11:30. So I'll give you just a little bit more than 15 minutes. Back in here at 11:30 sharp. Thanks, everyone.